Good day and welcome to this, the third in our series for the period ending 31 December 2024. This is the offshore portfolio commentary, and this really just talks to the typical holdings in our client portfolios, in segregated portfolios offshore. We'll go through it quite quickly. As always, if there are any questions, comments, or you want any engagement, please feel free to reach out to us. So we think it's probably worthwhile to have a look at what world markets have done, just for context. Maybe ignore the shorter term. Let's look at the 1 year. You can see the US. We had this discussion in the asset market review, powered by principally the technology sector, up around 25 to 23% on the Nasdaq and the S&P 500, whereas the Russell 2000, the broader market proxy, you could call it, far more, sanguine, if you want to call it that, with 10% gain. Europe, not spectacular, up 6% on the FTSE, 5% on the Stocks 50, and then China and Hong Kong actually having quite a good time of it. But as you will see, and as we discussed in the asset market report, very much a low base scenario. And looking slightly longer term, over a 3-year view, once again, the Nasdaq is powering the S&P 500. You can see on a 3-year view, in fact, the Russell 2000 to December was down, and the stocks and the FTSE unspectacular or uninspiring. Remember, these are aggregate returns, not per annum. FTSE up 11 over 3 years, only 8 over 5 years. Stocks looking a little bit better, and then China and Hong Kong still down over a 5-year view. Right, what we're going to do now is just talk a little bit more in detail about one of the new positions that we've added, but then we're essentially going to run through the holdings, showing the performances over a period of time, always not perfectly aligned, because we might have bought Microsoft 3.5 years ago, whereas the data might be 3, or it might show a 5-year graph. So it's not always 100% accurate as to what our client gains or mark-to-market losses may be, but it gives a sense of the underlying performance. A couple of the actions that we've taken over the last year or so. Additions, we added two positions to client portfolios. The first is the Agri Fund, which we did briefly touch on previously, and we're now going to unpack in a bit more detail, as well as the US Treasury Fund. Although that fund has performed very, very poorly, of course, we came in after yields had risen, and we're looking a lot better than anybody who might have bought it 3 or 4 or 5 years ago. Diageo, for clients that didn't hold it, we added, or we bought, and for those that had relatively small weightings, we added those. And then we also, for some clients, added the China ETF as well. And then when we get through them, we'll maybe just explain the rationale around the ETFs. Then we sold Micron for almost all clients. We trimmed those positions back, in part because they'd become what we thought was excessive, but more importantly because we had concerns around the valuation. And if you look at what the share has done over the last while, I think that has proven correct. Then we also trimmed for a couple of clients overweight positions in Shell, JP Morgan, and Microsoft, but only when those were considered to be excessive. All right, so what we wanted to do now is just talk a little bit about the Agri ETF. And really what we're trying to do is play the agricultural theme, just as we're trying to play the China theme, because we did once upon a time have one in renewables, but very difficult to trade directly in China. We figured if you like the narrative and you like, let's say, the valuation on the broader market, understanding always going to be anomalies, but if you like the underlying index, or you like the underlying theme, be it US Treasuries or the agricultural sector, ETFs give you a very elegant and cost-effective way of getting exposure. So the Agri ETF, the iShares ETF, we bought it principally on the belief of, that supply and demand will matter. I've drawn a very rudimentary supply-demand chart there, showing two supply scenarios and two demand scenarios. Effectively, what we're showing is that demand is going to increase as population increases, but maybe supply won't be able to quite keep pace with that. So obviously that will have an impact on price. But I think the theme there is that demand is just going to grow because of population growth and maybe economic upliftment, but also very, very importantly, we don't think because of climate change particularly that supply is actually going to be as easy to match. So we think that there's going to be a scenario in terms of which even if producers wanted to produce a hell of a lot more, they may not necessarily be able to do that. So it may be a case of, food inflation is a reality over the next 10 or 5, 10, 15 years. And that's, of course, part of this hypothesis. But yeah, supply being hurt mainly by climate change, but also, land is becoming increasingly pockets of land because of climate, but also because of over-farming and other issues, unusable. And then we also believe, quite sad, but many of the smaller farmers in the world will fail. I'm talking commercial farmers. Then I'm really not trying to go into too much detail here, but what I really wanted to illustrate is on a very simple level. The chart on the left shows the expected world population growth going from, let's call it 8 billion today to around 10 billion in 2050. 2050 for many people sounds like a very far away, but it's only 25 years. It's a generation. And the bottom line is, 8 to 10 is a massive percentage increase. And that's just going to translate into demand for food. On the other end of the scale, what we're showing here is from 2000 to 2023, the number of farms in the US has actually declined from almost 2.2 million to about 1.89 million. That's about a 13% decline. And the reality is that trend is going to accelerate, in part because of climate change, but in part because of the factors we're going to discuss now. So really what we're talking about is a scenario in which we believe that the supply of food and agricultural products is going to be quite tight, and demand is going to grow. So bottom line is we believe the agricultural sector is going to go through a very significant transformation. And that's really what we're illustrating on this slide. We're talking about agriculture becoming more commercial, more technical, more expensive, more intensive, requiring more diversification, more creative solutions, people probably having to diversify across products, across geographies. And the bottom line is we believe it's going to become more and more business oriented, more commercial, and it's going to favor bigger companies, quite frankly, and it's going to become increasingly capital intensive. So we believe those are some of the key themes in agriculture. Obviously, smaller farmers we think will probably be losers in this equation, and the winners will be the bigger producers, so the likes of a Tyson Food and others that produce massive quantities of product, but also those that support those commercial operators. So it'll be specialist suppliers of seeds and inputs. So it could be agricultural commodities. If you look at the equipment and the harvesting equipment and the technical solutions, and I think it's important to say agriculture has become a very, very technical field, and it's probably going to get even more technical. Things like animal nutrition and animal health and crop management and crop protection. So anybody who's in that space and servicing the commercial area, I think has an opportunity for a better future. And obviously, if you look at the iShares ETF, that's exactly what it gives you. So, if you look consumer staples, so effectively food, 40% of that basket, materials, which is a variety of things, all the way from seeds and fertilizers, all the way through to equipment, and then finally industrials making up 20%. You can see very much dominated by the US, and you'll see some of the companies now, 52%, and Japan obviously also quite a significant player with one or two prominent players in that space, and then interestingly enough, the likes of Saudi Arabia coming in. I'm not going to dwell on the companies. Safe to say that there are some real powerhouses there. What I thought I would do is maybe just introduce you to a couple of the constituents. What we've illustrated here is, the 5 biggest holdings, starting at the bottom right, ADM, which is Archer Daniels Midland. Then you've got Corteva. ADM is in seed and in animal nutrition and in human nutrition, as well as technology related to that. Corteva, the one on the left of that, is more in seeds and crop treatment. Then you've got Deere in the middle, which, as everybody knows, makes tractors and harvesters and some very, very fancy and very expensive equipment. Then top left, we've got a company called Tyson Foods, which is effectively a protein producer. You can see 38% of their revenue comes from beef production, and then you can see chicken, for example, in the 30s, and others, and pork obviously making up some of the balance. And then top right, we have the 5th player in that space. So when you look at these 5 companies, they are massive. They've got global footprints. You can see, for example, the likes of Corteva operating in North America, Latin America, Africa, Asia Pacific, pretty much everywhere. Similar story for all of these companies. And sorry, I didn't mention that the top right is Nutrien, which is a fertilizer business producing potash and similar crop enhancements. So these 5 businesses, which represent I think around 25 or 30% of the index, have revenues of over $240 billion a year. And you can see, some of those, just take ADM as an example, adjusted operating profit or adjusted EBITDA of over $7 billion. Similar story for the likes of Deere, and maybe Corteva's operating EBITDA is slightly lower, but these are proper businesses, and I think you'll understand the theme that these are supplying seeds, feed, crop protection equipment into commercial operators, or in the likes of Tyson Foods, where they actually themselves are a producer. And of course, a lot of these businesses have processing capacity, etc. So that's really the narrative of the Agri Fund. We believe that it's actually quite defensive. Food, we believe, and food security is going to become a big thing. And we believe that the margins for food producers and the related industries are obviously going to improve. Then looking at the underlying performances of some of our holdings, it's important to say, that we may not have held JP Morgan for 5 years. We may have held it for 3.5 years. So it's sometimes a little bit misleading just looking at the performances, particularly when you look at holdings like Royal Dutch Shell, which are more than 3 years but less than 5. So we've opted to show the 3-year numbers because it's on average most of these positions would have been held for at least 3 years, but a lot of them were added sort of in the COVID era, so not quite 5 years. All right, so, and we've weighted this into, as we've done the graphs that are going to follow, in terms of the biggest holdings. And it's encouraging to see over a 3-year view, some of our biggest holdings being HSBC, JP Morgan, and Shell have done very, very nicely, up 79%, 51% and 53% respectively. And if you think that both HSBC and Shell are London listed, and you saw the 3-year numbers there, we're very happy with that performance. Obviously part of that is off the lower base courtesy of COVID, but that also was reflected, quite frankly, in the index. The BNP Paribas numbers are a little bit misleading because on average clients are up very, very nicely on that holding. It was somewhere between a 3 and a 5 year holding, 5 years that we bought it, probably around 4, and that generally has done very well. Similarly, if you look at Micron, I think our average in price for clients was around $40. We sold quite a lot at 109 and still at 102. It's not reflecting the reality. So we've held that one probably for 4 years. So although Micron is down 10% over 3 years, the reality of it is for clients, we're actually up quite nicely. Then Microsoft is probably quite a similar story. We up very, very handsomely there, probably around 50%. But on a 3-year view, it's also done quite nicely, 25. GSK is it's been disappointing, and we'll see the graph in a second, but it's important to remember that the Halion unbundling needs to be removed from that. So it's probably more a break-even situation than being down 17%. Then Volkswagen, beyond any shadow of doubt, has been the most disappointing holding. Yeah, then Brookfield Renewables, again, we're down a little bit, maybe not quite as much as that indicates. Richmond, we've held it for just over 2 years. So, the gain is more than 19%, but it's not quite what it would have been on a 3-year view. Halion's relatively new. You can see over a year it's actually done quite well. That's the unbundled personal care and OTC portfolio from GSK. Then the Stocks 50 has done reasonably well over a 1-year view. On a 1-year view, the iShares has done nicely. Process has done well since we bought it. And BMW has, like Volkswagen, been a bit disappointing, although it's relatively outperformed. So I think on balance, we would say, the holdings have done well, either over the 3-year period or, from when we would have bought those holdings, with the big disappointments, as we said, being probably iShares, Volkswagen, and Diageo. All right, now we're going to go into the price graphs of the underlying holdings. We've taken a 10-year, and we haven't held, for most clients, we haven't held in for anywhere near that length of time. But here you can see HSBC, from the lows of COVID, sort of late in 2020, it's had a phenomenal run. We've sung its praises in the past as the emerging market play. Obviously, it was caught somewhat in the crossfire with the Hong Kong situation, but we think it's a very, very well-placed business. It's a powerful franchise, and we're still comfortable to hold it, although we sense that maybe a tighter operating environment for the banks globally may see it actually pull back a little bit, but we're happy with the fundamentals of the business. JP Morgan, a similar story, very, very well run, beautifully positioned, trading very, very well. $260, it really does look like it's overcooked. We bought this, quite frankly, at very, very attractive levels in COVID times for clients. So, we've more than doubled our money. We're very comfortable with the holding, but we do feel that it's maybe a little bit overcooked. So we just need to monitor the weighting, remembering that some of our biggest holdings as an aggregate are banks between HSBC, JP Morgan, and BNP Paribas. So we're just keeping an eye on that valuation, particularly courtesy of the latest rally. Then Royal Dutch Shell, generally we bought this one also in COVID, so we've held it for 4 and a bit years probably. As you can see there, it was trading at about 10 or 11 pounds at the depths of the COVID shutdowns when oil imploded, and you'll remember that NYMEX futures were trading negatively and all sorts of other chaotic times. It's recovered quite nicely. It's a business that's got a blend of offerings, so actually a bigger producer of natural gas than crude, and of course you've got not just upstream, you've got downstream, and they are trying to pivot into some new cleaner energy. So we sense that it's probably done its thing. We would now, I would imagine, probably be guided by opportunities. So if we find something else to put into portfolios, this would probably be one of those that we would look to offload, particularly as we discussed in the big picture. More oil is going to be coming on stream in the US, and I think that'll probably put downward pressure on oil prices. And you've already seen natural gas prices, in spite of the sort of Russian supply issue into the Eurozone, those prices also coming off a little bit. Then BNP Paribas, once again, doesn't fully reflect. We bought this in the mid 40s, so or if you look on a 3-year view, it's maybe been a little bit disappointing. But from when we were getting in around the mid 40s in 2020, still very, very nice gains. And I think the issue was always we were buying it at a discount to book, and I think that story remains, and a very, very well run, we believe, business with sort of core European banking and markets operations. Then Micron Tech, once again, as we're saying, I think we paid $40 for it. It's on a 3-year view, hasn't done awfully much simply because of the timing of the start and the end. But we've done very, very nicely. We are pleased that we trimmed our holdings for clients around this level, because really the weighting just became a little bit excessive. And as you can see, it has actually in the more recent past been sort of falling down to just above 80, and I think that's just gravity kind of taking over, courtesy of the tech bubble maybe losing a little bit of inflation. Then Diageo, if you look over a 5-year view, been very, very disappointing. Obviously, for many of our clients, we actually bought this quite a long time ago, probably 2017, something like that. So we would still be up, but not massively. We see the sell-off courtesy of the difficult trading operations in Central America, South America, as an opportunity. We think as a business with lots of operating leverage when the tide turns. We're very comfortable with it. Just one of those, not everything in the portfolio always looks great, but you can see for a very, very long time, this thing was trading at ridiculous ratings. It's almost halved. So trading, we believe, very, very cheaply now, or cheaply, whereas at 35 or 38 pounds, it was actually quite expensive. Then the US Treasury bond ETF, and all we were trying to do there is get a bit of a yield, pick up the yield to maturity. Looks reasonably good across the yield curve in the US. This is actually obviously the price of the ETF as opposed to the yield. We probably virtually flat, maybe slightly down on average after the little bit of a bond wobble in the US. But we are still very comfortable. So, we haven't held it for this duration. We've only held it for a year or a little bit less. So, it looks a lot worse than it is. And in fact, we actually bought it and will be buying it at very attractive prices, relatively speaking. Then Microsoft, once again, we bought it very, very cheaply. Around the COVID time. And in fact, we bought all our US holdings. So JP Morgan, Microsoft, in large part Micron as well, at about the same time, as well as Shell. And all of those worked out very nicely. So I think on average, we're probably a little over double our base cost. It's obviously been quite volatile in the last while, based on the DeepSeek sell-off. So, but we still like the story. We spoke in our June presentation on the business and how it fits together, and the fact that although people got very excited about AI, the reality is it's actually from a contribution point of view quite small. Having said that, the valuation does look a little bit stretched, so it's one of those where we're also just sort of quite mindful of the price and the downside risk. Then GSK trading at, call it £14, looks really disappointing, but as we say, you also need to consider the fact that Haleon was unbundled. Obviously, being some class action risk, we very comfortable though. Great pipeline, great product portfolio, defensive pharma, which is the right way we believe to be positioned. Then Volkswagen, beyond any doubt, our most disappointing holding. We've held it for quite a long time. It traded very, very well, and then they obviously the EV boom, particularly the emergence of Tesla and some of the Chinese brands, just caught them completely off guard. So I think it was in large part a China play, but truthfully we underestimated the extent of the EV switch, and also the aggressive pricing of Chinese brands, particularly in China. So I think, there's value here. It's really, if they just need to right size the overheads. That's going to be an aggressive and a painful process for a lot of people, but you can see it's starting to tick up. So we're going to run it and obviously see where we go to from here. And one of the themes was actually we thought they were quite well placed in the electric vehicle market, but the mistake we made, frankly, was assuming you can take a Golf or another car that is designed for an ICE engine and you just dump an EV power plant into it. I think the world has clearly seen a preference for EVs that are built on the ground from the ground up as EVs. So anyway, you're always going to have these in the portfolio. At least on the bright side, it's looking a little bit better than it has, but it is in what we would call the sick ward. The iShares Agribusiness ETF, we bought it about a year ago, so we're almost flat, well, not even a year ago. So we're almost flat. We've explained the story. It had a good run from COVID, courtesy obviously of food prices. Of course, 2022 as well, the agri industry did very well with food prices going through the roof, and the likes of Nutrien as well subsequently come off. If you look at the valuation of, let's say, the top 5, you're probably sitting with a PE of around 20 times, decent cash generation. So it's not ridiculously expensive, and we still believe in the narrative. Then the iShares MSCI ETF. I suppose the big question, we spoke about this in both the asset market review and the big picture, is whether we feel that China is just going to slip into the mud and disappear, or if you feel that they'll dig deep, they'll reinvent themselves, and they will throw the correct stimulus at the problem. As you can see from the beginning of 2024, you saw quite a strong run. It's subsequently come off. Obviously, the Trump victory didn't help that, but we still believe in the overall theme. And we, in the asset market review, did talk about some of the bigger constituents there. The single biggest of which, of course, is a gigantic brewer and distiller, which is exactly what we're illustrating here. So financials around 23%, technology, interestingly, and that's obviously a combination of plays. So everything from the Tencent and the Baidu's and the likes, together with industrial. So actually quite a nicely balanced portfolio. And Kwai Chow, as we discussed, is that distiller and brewer. So actually a relatively well diversified portfolio or index. As you can see, the top 10 represent under 20%. Then Process, again, this was more opportunistic. We bought it as we illustrated there in March of 2022. So although it's been a little bit choppy of late, although not to the 31st of December, this weakness we've seen obviously came after Tencent was added, to the China military list. But if you look at it, Process up to the end of December did very nicely, and I think we bought it reasonably well, and it was on one of these sort of sell-off kind of opportunities. BMW has also been disappointing, like VW, similar story, although very well placed, interestingly, in the electric car market, but performing a lot better than Volkswagen. Then Richemont, another one that we just, when it got sold off, and it was then looking very cheap to us in, I think it was May of 2022. Yeah, actually there on the graph, and we concluded that almost 13%, I think it was at the time, of the share was actually held in cash. It was highly cash generative, and this nervousness around particularly China we thought was overstated. And you can see the phenomenal performance, and you saw the blockbuster results that they delivered the other day. We think it's overcooked right now. We think that it's ahead of the fundamentals, and it is actually quite a cyclical business. So it's like a Shell, maybe one of those that we need to apply our mind to, and if we conclude that maybe the next 2-3 years are not as rosy as the market thinks, it might be opportune to actually offload those. Then Halion has actually done really well since it was unbundled out of GSK. Good portfolio, just trading very, very nicely, and seems to have somewhat captured the imagination of the market. So up, probably about 20% from when it listed, but small holding. I think for every pound we've got invested in GSK, we've probably got about 15 pence or maybe 20 pence invested in Halion, so it's really quite a small holding. Then Brookfield Renewable, obviously the higher interest rate environment hurt them very recently. So since January, of course, Trump coming into the White House and his sort of less than favorable position on green has hurt them a little bit, but it's still, we believe, a good long-term story, even if the US government is not mad about clean energy and the need to decarbonize their economy. Many companies and other countries are very committed to it. And GE Aerospace, a very small holding, obviously one of the numerous unbundlings out of the General Electric structure. And then finally, the Stocks 50. Because every holding, smaller than this really is quite insignificant in aggregate. Stocks 50, we bought it, or the bulk of them, for clients shortly after the Russian invasion into the Ukraine. And that obviously has actually worked out very, very nicely. So we hope this has been informative. We hope you've enjoyed it. And we invite you to watch the local commentary as well as the Kerner Flexible Fund commentary. As always, we welcome your feedback, good, bad, or indifferent, and we're always happy to answer your questions. We thank you for your time and attention.